Hello everyone. Today we have with us Mr. Arvind Mathur as our guest speaker for the podcast series. Welcome to the podcast, sir. Please allow me to introduce you. Arvind, sir, is a pioneer of private equity and venture capital in the Asia Pacific region. He is currently the chairman of Private Equity Pro Partners. He has over 25 years global experience in private equity, venture capital, IPOs, M&A, and investments. As an FRM and CFA Charter, he has attended executive education in private equity and hedge funds at the Harvard Business School, training at Goldman Sachs and Citi, and the US SEC in Washington D.C. And to match that level of understanding with Arvind sir, he has specially invited his daughter, Sitara Mathur, a postgraduate at King's College London, to moderate this podcast. Welcome to the podcast, Arvind sir and Sitara ma'am. It's a pleasure having both of you on our podcast.
Good afternoon, everyone. Delighted to be here.
Good afternoon.
Okay, great. So let's get started. To begin with, I guess we'll dive right in. What is private equity? What is venture capital? And please distinguish these two forms of capital. And if you'll be able to, please provide an illustration of these concepts with the help of a case study such as Policy Bazaar.
Thank you, Sitara. That's a very interesting question. Private equity and venture capital have become extremely important in India and around the world, including emerging markets as well as advanced countries. In India, I'll just go back give a little bit of history. In India, private equity and venture capital really began in the late 80s, primarily due to the work of the Asian Development Bank and IFC. These were the pioneers who created private equity funds for investing in India and other countries, as well as direct investing. And then later on came institutions like ICICI that got into venture capital and private equity in India. And then around the year 2001, the industry began to take off, and a number of very respectable and good performing funds like Chris Capital began their business and had great performance. And then again, around 2005, it took off again. And then SEBI, of course, was the regulator. SEBI's done a very good job. They had the venture capital regulations initially around 1996. And then in 2012, they brought in path-breaking regulations known as the Alternative Investment Fund Regulations 2012. And from 2012 till 2022, which is the current year, they have made a number of helpful changes. Of course, more changes are necessary, and that's all part of the development of the law in a particular country. So, and SEBI has allowed three types of funds, which are venture capital, private equity, and specialized funds, which are called category three funds, primarily hedge funds. But going back to your basic question, Sitara, what is private equity and what is venture capital? So I would start with, and also what is angel capital? I think we should really look at it from these three lenses. So it's all about entrepreneurship, actually. When an entrepreneur begins his business, he probably has one friend or two friends, and they call themselves founder and co-founder. So it's good to have a co-founding team rather than be all by yourself. It's not wrong if you want to go all by yourself, but it's considered nice to have a co-founding team. In the beginning, they have an idea to start a business. They're really excited about it, enthusiastic about it, but they don't have the capital. So they may have a big idea to start some sort of a business, but unless they come from a very wealthy background, they just don't have the capital. So that's a big pain point. So you need a solution for that. So what are the solutions if you do not have capital, but you have an entrepreneurial bent of mind? What are the solutions? Well, the first solution is to bootstrap. Now, what is bootstrap? Bootstrap means you just depend on yourself. You say, you know what I'm going to do? I'm somehow going to make some product somehow with a very little amount of money. I'll somehow start selling and I will get my own cash flow. And instead of spending this cash flow on Mercedes-Benz cars, I'm going to plow it back into the business. So it's sort of self-financed, it's bootstrapped. If you can do that, that's a very good way to go. The problem with bootstrapping is that it takes time to bootstrap. The second thing is that because you're a new business, bootstrapping is not going to get you very far because you don't have a lot of capital. But to grow your business, you may need a lot of capital. So the growth of your company or your venture gets slowed down. But yes, bootstrapping is a valid technique of funding a business. The second approach for raising capital is you go to friends and family and connections that you may have with wealthy people or former executives who may be retired, and they have some money and they'll say, hey, look, nobody's giving you capital, but we'll give you 1 crore, we'll give you 2 crores, we'll give you 20 lakhs, 50 lakhs, $1 million, $500,000. So this is an informal group of well-meaning people who like your business idea and they're going to fund it. These are called friends and family and angel investors. So if you look at Nykaa, all of us know the great success of Nykaa. Nykaa started by a very fine professional lady called Falguni Nair. And she started it at the age of 52, I believe. And so she bootstrapped it initially. She found it difficult to raise venture capital. So she bootstrapped it and she pumped in rupees 40 lakhs of her own money. And her business model was not really initially appreciated by venture capital funds. So she had to depend on angel investors. So till around 2014, 2015, she started the business in 2012. She raised capital from angel investors and friends and family. Now, the thing is, here's the good news about India. In the last 5-7 years, angel capital has become a good source to fund entrepreneurs. There is an angel association called Indian Angel Network based out of Delhi. There's Mumbai Angels, there's Calcutta Angels, there's Chennai Angels, there's Chandigarh Angels. So all sorts of angel associations are sprouting around the country. This is really wonderful because entrepreneurs can go to them and request for capital. That doesn't mean they will get it. It depends on how viable their project is. It depends on their own entrepreneurial skills. That's how they will attract this capital. And then you have the third form of capital, which is called venture capital. Now, venture capital is, let's say, is a little bit more organized. It's structured as a fund. It's got its independent legal structure. It's got people or institutions rather investing capital. And you may have a venture capital fund of 100 crores, 300 crores, 400. And these are relatively large, much larger than what angels invest or friends and family would invest. They also invest in absolute startups. If they love your idea, if they love your business model, they also invest in startups, meaning right at the early stage. But within them, there are subcategories of venture capital funds. Some will say we are willing to invest at right in the beginning. They're called early stage VCs. And some will say, you know what, we're not so sure, the business might fail. So we're not going to be early stage. So typically what happens is that when a business starts, it's really a tiny business. When a startup starts, it's tiny. It needs a very little amount of capital. But when it grows, it needs more capital. When it grows more, it needs more capital, so on and so forth. So at each stage, it needs more and more capital. It's a capital guzzler. A growing business, a startup, is a capital guzzler. So it's going to have many rounds of financing. So initially, it might do bootstrapping, then it does friends and family and angel round, then it does a VC round. The VC round is like a formal round. It's called Series A. Then after some time, it needs more capital. That's Series B. Then there's Series C, D, E, F, G, H, I, J, K, L, M, N, whatever, several series over 8, 10, 12 years. Now, some VCs are going to say, we are really adventurous. You know what? We'll come in at Series A. But it's kind of risky at this stage because the company is not fully established. But some are going to say, no. We're going to come in only at Series C or D or E or F. These are called late stage VCs. And that's fine. Everybody's needed. All forms of capital are needed. But then comes a point where the business becomes pretty well established. Maybe by the time of Series D, that's about 7 years' time or 5 years' time, 4 years' time, the company gets, very solidly established. Now, at this point, they really want to grow rapidly and become really big, and they need lots of capital for this growth. Now you need growth equity. Growth equity is a form of private equity. So from venture capital, now the funds are coming from private equity funds. Now, notice we are not going to the public yet because the company is still kind of immature in many ways. So the private equity fund makes the company very professional. And 3% of such startups can actually raise capital from the public in what's called an IPO. And subsequently, more capital can be raised from the public in follow-on rounds or certain types of private equity known as PEPP. So let's summarize. What are the sources of capital for a startup? It starts with bootstrapping, then friends and family and angels, then venture capital, Series A, Series B, Series C, Series D. Then comes growth equity, which is private equity. And then finally, only 3% of startups in the world can go for an IPO. That's an initial public offering, which you see in the newspapers, like Nika had an IPO. Now, Sitara, you asked me, can I give an illustration? Can I mention a case study?
Yes.
And I'd like to mention a case study of Policy Bazaar, very briefly. Now, in Policy Bazaar, remember, an entrepreneur always starts with a pain point. Because why should anybody buy a new product unless it's solving his problem, right? Why do we have a mobile phone? Because without supposing there was no mobile phone with me, and I have to send an urgent message to my daughter or to my son or whatever, it'll be too late. I'm not there for them. So it's a pain not having it. So let's buy a cell phone. Now, so an entrepreneur first thinks about a customer pain point. And then he comes out with a solution. So what happened in Policy Bazaar? In Policy Bazaar, the founder, he had come back he was an NRI in England. And he came back to India and he found that his dad had bought an insurance policy from some Indian insurance company. And the premium was a certain amount, right? When you get an insurance policy, you have to pay a premium that goes from your pocket. And he found that they were really overcharging his dad. Not only this particular insurance company, but many, they were overcharging. And he told his dad, Dad, look, I'll negotiate and I'll cut this premium down by what, 60%? And he did it. So there was this pain point in India that people were buying insurance policies because they needed them, but they were just too expensive. The premiums are not in line with what they should have been. So he said, look, this pain point, I'm going to find a solution. And I'm going to start a website called Policy Bazaar. And every policy out there in the market, I'm going to put its price and its terms and benefits. And then people can choose, compare. It's a price comparison website. So if I want to get insurance for my medical problems, ailments, then if ICICI insurance is charging me 30,000 rupees premium, but HDFC insurance is charging me 20,000, and PNB insurance is charging me for the same insurance 14,000, then I can make up my mind, right? Which insurance I want. It's transparent. So he put up this website. And oh my God, thousands and thousands of people started coming on this website. So he added more features. And in companies that wanted to sell the insurance policy, they started advertising on his website. Then around 2014, 15, he made an app. And the company is doing extremely well. So now in this company, he started off with venture capital from a fund manager in Delhi. I think his name is Sanjeev Bikhchandani. Sanjeev Bikhchandani is a fantastic venture capitalist. I regard him as probably the #1 venture capitalist in India. So Sanjeev said, you know what, it sounds pretty interesting. He just came with this idea. You know, the founder of Policy Bazaar just came up with this idea to Sanjeev Bikhchandani. And, you know, Sanjeev Bikhchandani and his team in the VC fund in Delhi said, yeah, you know what, looks pretty sensible here. You know, prices will be put up there, people can compare. You know, this should really succeed. So chalo, isme paise dal dete hain. So Sanjeev Bikhchandani put in some small amount of capital. And then, as I mentioned earlier, that the business started growing rapidly and they needed more capital. So Sanjeev Bikhchandani provided more capital. Then they needed even more capital. He provided more capital. So each time, each round, Sanjeev Bikhchandani was financing it. And then it had many rounds, and then Tiger Global from the United States invested in it. And then finally, they did an IPO in the year 2021, and the company was valued at around $6 billion, out of which Sanjeev Bikhchandani made almost $2 billion. When I say Sanjeev Bikhchandani, I mean his fund. These are all approximate numbers. So that is an example, Sitara, of a case study where you have the company coming in, getting venture capital and fundraising. And I gave you a real life example. And this is just one example, a dramatic example. There are many such cases, but remember, the business, the startup must solve a pain point of the customers. That's my answer, Sitara.
Great, thank you for highlighting the various forms of capital, providing a great case study example. And while you touched on this subject briefly, I'd like you to delve more into the investment criteria of these different forms of capital. So if you could just highlight the investment criteria of venture capitalists, angel investors, and private equity funds, please.
Okay, so the founder of Sequoia Capital in 1979, 1980 in California. You see, Sequoia Capital is one of the creme de la creme venture capitalists in the world. He found that one very important criteria before you decide to invest venture capital. Look, the venture capitalist, what does he want? He wants to make an investment in a startup that is going to be successful and which is going to become large, really large, maybe capture the whole American market, the whole global market, or even a large market, if not the whole market. So the size of the market for that product is one of the most important criteria for a venture capitalist. Even for angel capitalists. The larger the market, the more they are attracted. So take Policy Bazaar. Policy Bazaar has a market potential of the entire Indian population, right? The entire Indian population can buy policies through Policy Bazaar. Of course, that's not 100% right because there'll be competitors. Maybe many people are never going to buy an insurance policy because they cannot afford it. But by and large, you've got 600 million people, maybe 500 million people who are your potential market for Policy Bazaar. That's huge. If 500 million people give only $1 million, give only $1 every year to Policy Bazaar, that's a revenue of $500 million. Can you imagine? So size of the market, of the product, the criteria number one. Criteria number two is the quality of the entrepreneur. At the end of the day, anyone can have an idea, right? I mean, I can have an idea that, look, let's have a website. We're going to put up the price comparison. What a great idea. Yes, it is a good idea. But will you actually do it? Will you do it efficiently? Will you actually scale it up into a truly bigger business? Will you actually be able to capture the market? Will you be able to manage the challenges of scaling into a large company? So the venture capitalist has to assess the quality of the entrepreneur. Is he honest? Is his background, like look at Nika. Nika, the entrepreneur, Falguni Nair, was 52. She had a very good background. She was an investment banker at Kotak. She had worked at Citibank. She had been around the world. She had seen the best, perfumes in the world, the best stores. And there was nothing bad about her background. So she was the right person. So the quality of the entrepreneur. The third is your solution to a pain point. Is your solution really a winner? Is the consumer really going to flock to your product? And then maybe, have you already begun the business or not? And if you have begun the business, are the customers really going Google Gaga over your product or over your service or over your app? Do you have a very user-friendly app or not? So those are the 3 or 4 key criteria. Firstly, does it address a pain point? Secondly, the entrepreneur, how good is he and his background? Is there anything in his background to tell us that, yes, he will succeed in running this business? Can he attract good partners, good co-founders, good employees? how large is the market? Then if he's already started selling in the market, then are the customers delighted with his product or not? That's called customer delight. So that's the investment criteria for venture capitalists. Now, of course, there are many other things. Now let's move to private equity. Private equity has a similar criteria, but private equity, remember, there's one difference between private equity and venture capital, is that venture capital comes in at a relatively early stage. Private equity comes in at a late stage, right? That means the issue of the customer, the pain point, etc., that's already addressed by the VC guys. So what is it that the PE looks for? The private equity investor, again, of course, they're going to look at the entrepreneur, the quality of the team, whether the entrepreneur is going to cooperate with the private equity fund or not, because the private equity fund may have some good ideas, whether he's going to be, does he have a habit of not listening to anyone? So the quality of the entrepreneur is number one. What is the track record of the company to date? Is the track record good or not? Are customers delighted with this product? And do we think that this company has still got great growth potential? Maybe, with our funds, we can help it scale even more to become even bigger. Maybe we can expand them into other markets. Maybe we can help them acquire other companies and become bigger. Then what is the quality of governance? Are these guys, honest guys? And do they run a tight shop? Meaning, do they pay their taxes? Have they got their accounting done, properly? They produce their reports properly? Do they run a tight ship or not? That means, is there proper hygiene in the company in managing the business? These are the sorts of multidimensional areas that the private equity fund would look into before investing. So,
Great.
Sitara, that's my answer.
Okay, thank you so much for your highlighting the investment criteria of these various forms of capital. Moving forward, what is the value addition by a fund manager?
Oh, great. See, now, whether it's a venture capital fund, whether it's an angel, whether it's a venture capital fund, whether it's a PE fund, they are writing a check, right? They're giving a check of 1 crore, 2 crores, 500 crores, $5 million, $100 million, $1 billion. Right? So the money is coming in from these sources of capital. But very often, a good business idea may have a good entrepreneur with a good business, may have competing investors. So maybe one Sequoia Capital wants to invest, and maybe Axel Ventures also wants to invest in your company. So whose money do you take? Whose check do you take? Money you will get from either, right? That's not the problem sometimes. Money is not, you will get it. So then the notion of value add comes in. Who is really going to help me beyond the check? Who's going to help me with new ideas for my business? I think my business can be a better run business. I think I need to enter the US markets. I need to enter the Indonesian markets. Maybe I need to enter South India. Maybe I need to enter North India. Maybe in my technology, I need some improvements. Why am I not as good as the number one company in my industry? My corporate governance is really not world class. How can I improve it? So the fund manager who's capable of providing you help in all these areas, That is called value add. So a fund manager is not only giving you a check, but he's also able and capable, or must be able and capable of, adding value to your business. So value addition is an extremely important aspect of private equity.
It's
Okay. I'd like to proceed with buyout deals. First and foremost, what are buyout deals? And can you please provide some examples of buyout investors?
Okay, good. Now, we talked about, a startup, right? The startup starts as a really tiny little business, maybe from a garage. And then it grows and it grows and grows and grows. Over years, several years, become bigger, bigger, bigger. And the entrepreneur, his age maybe starts off at 32. In 30 years' time, he's now already maybe 65 years old or whatever. And he says, you know what, now it's time for me to go to the beach. I'm worked hard, I've built a great company. All my staff can now run the business. Now I just want to go and be on the beach. So what I'm going to do is, if somebody wants to buy my whole business, you're welcome. If they give the right price, they can have it. So this is called succession. Now, or you might say, you know what, my children are there, but my children are not interested in my business. So I can't even let my children take over. So I have the succession problem. I definitely don't want to run it anymore. So what I'm going to do is I'm going to find a buyer. So there might be two types of buyers. One type will be somebody who understands this industry. So let's say this is a company that makes perfumes. So you might say, hey, look, who is the logical buyer for a perfume business? And maybe, the logical buyer is Estee Lauder. Maybe the logical buyer is Johnson & Johnson. So there are these 5 or 6 logical buyers that we should approach. Or there are these private equity fund managers. They have a lot of capital. Maybe they're interested. And you know what? Some analyst has told me that there are these 7 funds. They love consumer businesses. So they may also be logical buyers of our business. So why don't we approach them? So you go out and you approach these logical buyers. You say, hey, my company's up for sale, guys. Anyone wants to buy? And you organize an auction. And in that auction, to sell your company, selling a company means selling ownership. Selling ownership means sell all your shares or a majority of your shares, meaning you transfer control to the new buyer. And people love that. Johnson & Johnson say, wow, you know what, this company's got the whole Indian market, we'll just buy it. We'll bid for it. Estee Lauder might say, wow, this is terrific. We're going to bid big for this. The same way, a private equity fund might say the same thing. It's got lovely management, lovely product. And then there's a bidding one day. And there you have maybe 5 bidders. And who wins? Maybe the kind of where the other companies, so there are 2 categories of buyers. One is companies and the other is private equity funds. The companies are known as strategic buyers. The private equity funds are called buyout funds. That's what Sitara is, a buyout fund. And in the competition, in the auction, one of them may win the buyout and take over control of the company. That, Sitara, is a buyout, private equity buyout deal.
Okay, thank you. You've provided great insight into the various types of capital and how they operate. So moving forward, can you also briefly highlight what type of skills are required for a career in private equity or venture capital?
You know what? Let me first address the venture capital skill set. There are two types of people in my assessment have a role in venture capital. Actually, there are quite a lot of type of people. One is those people who have been successful entrepreneurs themselves. So if somebody has been a successful entrepreneur who started his own startup, who went through all the challenges of growing his company, fighting the competition, building the product, managing the employees, they've been through it, right? They know what it takes to build a successful business. So such people can be working in a VC fund, or they can start their own venture capital fund. The other type of person can be somebody who has been an angel investor, or somebody has worked for an angel, or has worked in a family office. So during his initial stages of his career, he was involved in making a lot of investments. And he knows what it takes to make a successful investment or not a successful investment. He's got that experience. He never ran a business, but he's got this investment experience. Maybe he acquired it in some working for an angel or a family office. This kind of person would also be a good VC investor. The third could be somebody with a finance background. The fourth would be consultants. If you've been a consultant with Bain and Company, or McKinsey, or any other consulting firm, these guys analyze the business and business models, and what is an appropriate business model that leads to success. And they can also be very successful, both as entrepreneurs and as venture capitalists. So by and large, these are the categories of people that you need to have in a VC fund. Now, in the private equity fund, there's just one difference, that the teams are divided into two parts, are segregated into two categories. One is what are called financial partners. These guys do the investment analysis. They're financially strong. And then you have operating partners. Operating partners who understand the business, who actually have run businesses. Because now you remember when we explained when we talked about private equity that they have to add value. So who can add value? If I've never worked in the perfume industry, how can I add value to a perfume business? So these are people who've actually worked in businesses, ran businesses. They've been the managing director, chairman, or chief technology officer, what have you, for many years. So The type of people needed are similar, but there's a slight distinction, particularly when it comes to the need for operating partners in private equity funds. And, if, let's say, there's a youngster, what can he do to get into a career in venture capital or private equity? What can he do? Well, he should go and he should try and get a job with family office in the beginning. Maybe he can get a job in a venture capital fund. He needs to have an MBA typically. You need to understand finance. You need to understand commerce. You need to understand business models. And that's how you start your career, from the bottom. And if you're lucky, if your dad can give you some money, then you can be an angel investor yourself. It's your own money. You can invest 5 lakhs here and 10 lakhs there, thinking, of course, logically, not just blindly making blind investments. And then you can also graduate to becoming a VC investor. So the world is open for you, all the youngsters who might be listening to this discussion.
Terrific. Moving forward, what are some of the areas in which private equity or venture capital has been invested? And a secondary question to that is, are they investing in cryptocurrencies?
Okay, so VC, and first let's talk about venture capital. Venture capital typically invests in businesses that are driven by some sort of technological innovation or some sort of a technological application which makes it easy to grow the business and are typically innovative. And that innovation is solving a problem or solving a pain point of a customer. Those are the sorts of businesses in which venture capitalists invest. Now, these need not always be a tech company, but in today's day and age, following the pandemic and even before that, most businesses are adding a layer of technology into their businesses, including, even there's something called agri-tech. Agricultural businesses are taking advantage of technology. Of course, it's now well known that education is being done through tech models, ed tech. So these are the sorts of health tech. You can get advice from a doctor without necessarily going to his clinic or without going to a hospital. It can be done remotely. So these are sorts of businesses in which venture capital is interested in. Private equity, on the other hand, is interested in companies that have got a proven track record and are ready to grow and scale even more. And they could be just about anything. Let's take a practical example of the pandemic and e-commerce. So what happened with the pandemic was that people stopped going to shops, right? If you wanted to buy something or you wanted to have a nice meal in a restaurant, you wouldn't go there. You just stay at home and order to buy, say, a transistor radio, or nobody buys a transistor radio, but let's say you wanted to buy a new mobile phone. You just go onto the internet and you order your mobile phone, maybe through Amazon.com. These e-commerce companies, right? Now, these e-commerce companies, when you buy a product through an e-commerce website, you want it right then, right? You want it immediately. But if Amazon is going to ship the mobile phone from Chennai to Delhi, it's going to take a couple of days, right? So these e-commerce companies had a big need to create warehouses in different parts of India, in Hong Kong, in United States, And there was a huge growth of warehouses. And if I'm the warehouse owner, oh my God, they're going to pay me, right? They're going to pay me money to let them use my warehouse. So private equity made investments in warehouses. Ever since e-commerce took off, and even more, they benefited during the pandemic. But that's just one example. They invest in hospitals. They invest in, I would say they would just about invest in anything that can grow, which people need. It's a wide range of industries. They've even started investing in, the latest area in which some private equity funds, not every, but a few private equity funds have ventured into, is cryptocurrencies. So what else was part of your question, Sitara? Can you repeat your question, please?
Sure. I was just wondering if they are investing in cryptocurrencies first and foremost, and then I have a follow-up question to that once you've provided me with
Okay.
your answer.
So now what's happened is that cryptocurrencies have been in the limelight since 2009, 3rd of January 2009, when Satoshi Nakamoto wrote his paper on the blockchain for Bitcoin. And ever since then, initially there was this Bitcoin currency, only one currency, the most important currency, cryptocurrency. And then there was Ethereum sometime around 2013 or 14. And then many more cryptocurrencies have come in. Initially, only the venture capital funds, they like to invest in innovation. They're interested in innovative ideas. So venture capital funds in the United States, they started making investments in cryptocurrency businesses. And then the private equity fund boys, they were still not in this game. Partly because, the business is too small in the beginning, right? As we discussed previously. But over time, now it's 2022, right? So they started off around 2009, 10. Now it's 2020, 10 or 12 years have elapsed. Some of these volumes of businesses have grown large. Now they're getting a little bit more mature for private equity deals. So how did they do it? So there's a gentleman called Henry Kravis in America. He is one of the main general partners of KKR, one of the top private equity funds. So he, on his personal account, his personal money, he started investing in cryptocurrency businesses, not in the cryptocurrencies, but related businesses. Like I just mentioned to you, e-commerce, you can invest in e-commerce, or you can invest in the warehouse. So in the same way, they were investing not in cryptocurrencies, but in related businesses, which were part of the ecosystem of cryptocurrencies and which were also growing rapidly. So he made a couple of successful investments. And then KKR, which is the renowned private equity fund in America, has even started making private equity investments in cryptocurrency businesses. And not only them, but also Bain Capital Ventures, etc. There's a venture capital fund in America, in California, called Andreessen Horowitz. They were pretty much amongst the first large VC funds to enter the crypto space. They entered it and started making investments in 2012, I think, in a crypto exchange called Coinbase. So that, Sitara, is our examples. Those are some examples.
Great. And to delve more into the topic of cryptocurrency, Is there any fundamental value in cryptocurrencies? And does blockchain have practical applications?
That's a great question, and there's a big debate going on out there that this cryptocurrency thing, is it just a game, or does it really have any fundamental value or not? And there are people, very reputed people, who say that, you know what, this just doesn't make sense. One of them is Professor Nouriel Roubini. He was interviewed by Goldman Sachs, where he gave his reasons why he thought that cryptocurrencies really had no worth, no fundamental, no intrinsic worth. Even the Reserve Bank of India governor made similar statements, and the Reserve Bank, one of the deputy governors of Reserve Bank of India. So that's on the one hand. On the other hand, where is the value? Where is the value in cryptocurrencies? It's important to understand this. And I'd like to mention 2 or 3 dimensions in understanding what is the value underlying cryptocurrency, or the fundamental value. One is that you can use cryptocurrency and blockchain to build various apps. For example, take real estate. If I own a home, how is there proof that I own it? There are some papers I have, but they could be forged. The government has some papers of the registration of my title, but those can be burnt. So blockchain can be used as an application for all title deeds of real estate. And for such a beautiful system that you cannot break into, which will prove definitively that I own my house, people are going to pay for this, right? It's fundamental value, it's meaningful. In the same way, there are many applications of blockchain. And to use the blockchain, you really need to acquire a cryptocurrency. For example, the Ethereum blockchain has what is called smart contracts, which are self-executing smart contracts. And that enables you to make several types of applications, which help us in our real life. And that is the fundamental value. It's one way to think about it. The other way to think about it is that the new generation, the generations which were born after 1990, they're different from many of us who are older. One difference is they believe in communities. For them, a digital asset is like a real asset for them. They're willing to pay for it. So cryptocurrency is a digital asset. It's not something real, right? Like this, or like a currency note. But for this generation, it believes in communities, which has grown up with computer games. For them, these digital assets are real for them. And as time passes over the next 10, 20, 30 years, many of us old folks will fade away. And these youngsters are going to come in, and their values will really run this world. And for them, it does matter. They think it is something of fundamental value. These digital assets are fundamental value. So that's the way, one is looking at cryptocurrencies having fundamental value. They, for instance, people would pay, Sitara, your brother would play these games. And in these games, computer games, they would buy something, actually pay for a digital asset, right? Now people are paying for something called non-fungible tokens, which is nothing but a digital asset. One aspect that is, one dimension that's there is that these cryptocurrencies have got an inbuilt algorithm which restricts their supply. So there's scarcity. And that scarcity ensures that the value is going to keep rising. So this is the line of thinking. I'm not saying that this is accepted by everybody, but this is the line of thinking which is driving interest in cryptocurrency investing.
Great insight into the current, state of cryptocurrencies and your thoughts on the value of them. And in this current state of climate change, I'm curious, are private equity and venture capital funds concerned about environmental degradation, considering there's now a huge push for and a growing need for sustainable solutions?
Oh, yes, of course. See, the one has to understand what drives these venture capital and private equity funds. See, these are huge funds. They have tens and hundreds and billions of dollars of capital. This capital that they get comes from where? It comes from institutional investors like pension funds, and pension funds are there for employees, right? So they have certain values. The investors in these funds have certain value. They care about the environment. They care about climate risks. They care about social correctness. They care about things like job creation. So when they sign a check and give it to a private equity fund manager, they demand that the private equity fund manager in its investing activities will not cause damage to the environment, will address and mitigate climate risks, will work towards human dignity in the supply chains of their portfolio companies. So this is mandated to them. It's called ESG policies, environment, social, and governance policies. Today, a fund manager cannot function without great regard for environment, social, and governance best practices in its portfolio companies. And if these things are absent in the business, good practices of ESG, they will not make the investment in the first place. Then there's a niche area of private equity, and it's called impact investing. Impact investing is where you invest in a business that caters to the needs of low-income people. So you might invest in a low-income housing project. So where houses don't cost more than 30 lakhs. You might invest in such a business, such a real estate builder. Or a school that is where the children are from, whose parents have a very low income. Or a hospital that's catering to very low income people. You can make these sorts of investments. That's called impact on society. There's a whole range of such impact investments. And that's also growing. So Sitara, short answer to your question is that yes, they do very much care about environment risks and social responsibility, and they clearly address climate change and climate risks.
And can you also delve a little bit more into what impact funds are?
Yeah, so I just explained impact funds. Impact funds are, they're just a pooling where investors pool their capital and there's appoint a fund manager. And the fund manager is mandated that they will only invest in companies which have a beneficial impact on a certain strata of society which has been ignored, whose income is low, and which could be, their essential needs, meet some of their essential needs in terms of products, in terms of services that I had mentioned previously.
Terrific. And just the last question to end this. What is some advice that you provide to your students who wish to forge a career in entrepreneurship or finance?
Well, the advice is that they should very sincerely do their studies first and foremost. Secondly, they should start early. If they want to get into the space of venture capital, private equity, they want to get in the investment space, I would say you start early. Start early at the age of 12, 13, 14, 15, 20, 21, it's never too late. Start investing. Start investing small amounts of money. Make mistakes. That's the right time to make a mistake. If you look at Warren Buffett, he started investing at the age of 12. And you get, by the time you're 18, or if you start, the earlier you start, then by the time you're 20, 22, your knowledge, your understanding of investments becomes really nice. And that will help you in case you want to make a career in venture capital. Coming to entrepreneurship, in the entrepreneurship world, again, you could do the same thing. You could start some sort of a business. You could talk to your dad. You could talk to your mom, your uncle who's doing business. You could talk to other entrepreneurs. Listen to them. What makes a successful business? How do you start a business? There's great potential in the world today. Think of innovative ideas. Think of customer pain points. And do something. If you can start a business, on the side, start a little business. You start understanding what are revenues, what are expenses, how do you attract customers, what makes customers happy or unhappy, what's customer delight all about. So that's what I would say, and attend a course, attend a business management course, undergraduate course, postgraduate course. And now, you're also lucky. There's so much free material available on YouTube. Top businessmen, their experiences, they provide them to you on YouTube. So the world is there for you to pick it up and take it and become great entrepreneurs, great investors, great venture capitalists, and great private equity fund managers. That's what I would say is my recommendation.
Great. I'd like to say thank you very much to Mr. Arvind Mathur for providing these terrific insights into the types of capital, investment criteria, cryptocurrencies, and of course, how to be successful in this field.
Yeah, thank you so much, Arvind sir. And thank you so much, Sitara ma'am. You really set the tone of the conversation. Thank you so much.
Thank you.
Thank you, Siddharth. Thank you very much.
Thank you, sir.